You think you own stock. You don't. You own a claim to stock ... a piece of paper ... a digital promise. But someone else, someone you've probably never thought about, actually owns your shares. They vote your shares. They decide what happens with your money. And right now ... as you're watching this, they're making decisions that affect your retirement ... your savings, and your financial future. Without asking you, without telling you, without your permission, I'm Walter Grant, and welcome to Draxiver. Today, I'm going to show you something that will change how you see the entire financial system. There's a company managing $10 trillion in assets. That's more than the GDP of every country on Earth, except the United States and China. This company is the largest shareholder in Apple, Microsoft, Amazon, Tesla, Exxon, Mobil, J.P. Morgan Chase, Pfizer, and 496 other companies in the S&P 500. Software system manages $21 trillion across the global financial system. In 2020 ... when COVID crashed markets ... the Federal Reserve hired this company to buy assets, making them both player and referee in financial markets. This company ... is BlackRock. And if you have a 401k, if you own index funds, if you've ever invested in an ETF, BlackRock votes your shares. Not you, you. Let that sink in for a moment. You put in the money. You take the risk. You check your portfolio hoping for gains. But when it comes time to vote on who runs these companies, on executive pay ... on mergers, on policies that affect your everyday life, BlackRock speaks for you. And they've never asked what you think. This isn't conspiracy theory. This is market structure. This is documented. This is public. And by the end of this documentary, you'll understand exactly how BlackRock controls your financial life through 5 specific mechanisms. You'll see why this is more dangerous than Standard Oil or J.P. Morgan's trusts ever were. And you'll have to make a choice about what to do next. Because when one company owns significant stakes in every major corporation, when one AI system manages risk for the entire financial system, when one CEO has more influence than any elected official, you're not living in a free market. You're living in a financial oligarchy, and BlackRock ... is the oligarch. Now, before I show you how BlackRock controls everything ... you need to understand what BlackRock actually is. Most people think it's a bank. It's not. Banks take your deposits and make loans. BlackRock doesn't do that. BlackRock is an asset manager. They manage money for other people, pension funds, sovereign wealth funds, insurance companies, university endowments, and individual investors like you ... through ETFs. All these entities hand BlackRock their money. BlackRock charges a fee, usually between 0.03% and 2%, and invests according to each client's strategy. Here's the scale you're dealing with. BlackRock manages $10 trillion as of 2024, up from $4.3 trillion in 2013. They doubled in just over a decade. To put $10 trillion in perspective for you ... that's more than the total value of all U.S. currency in circulation, physical and digital combined. That's more than the GDP of Japan ... Germany, and the UK combined. That's 40% of total U.S. GDP. One company manages assets equal to 40% of America's entire economic output. And BlackRock isn't alone. Vanguard manages $8 trillion. State Street manages $4 trillion. Together, these 3 firms manage $22 trillion, about 90% of U.S. GDP. But BlackRock is the largest, the most powerful, the most influential. And here's what makes BlackRock different from Vanguard. Vanguard is technically owned by its fund holders. BlackRock is a publicly traded corporation. It has shareholders, ACEO, profit incentives. This matters because BlackRock makes decisions to maximize its own profit, not necessarily your interest. Let me tell you how this started. BlackRock was founded in 1988 by Larry Fink and 7 partners. Fink was a bond trader at First Boston, who made a catastrophic bet on mortgage-backed securities. He lost $100 million for the firm. He got fired. But he learned something crucial from that failure. Risk management is everything. If you can measure risk better than anyone else, you can beat everyone else. So Fink and his partners built a risk management system. They called it Aladdin. Asset ... liability ... debt, and derivative investment network. This system would become BlackRock's secret weapon. And I'll show you later exactly how Aladdin now controls your financial future in ways you never imagined. Initially, BlackRock managed money for institutions, but in 2009 ... everything changed. BlackRock bought Barclays Global Investors for $13.5 billion. This acquisition brought iShares ... the world's largest ETF platform, suddenly ... BlackRock wasn't just managing money for the wealthy elite. They were managing money for millions of everyday investors like you, through index funds, through ETFs, through your retirement account. This changed everything. Because here's what they discovered about you. You don't pay attention to proxy votes. You don't care about corporate governance. You just want returns. And while you're checking your portfolio once a month, BlackRock is voting your shares. This gave BlackRock enormous power across the entire economy. Today ... BlackRock offers over 1,130 investment products. The most famous is the iShares S&P 500 ETF, ticker IVV. If you own this ETF, you own a tiny slice of 500 companies, but you don't vote those shares. BlackRock does. With $400 billion in IVV alone, BlackRock controls millions of votes in every S&P 500 company. Multiply this across all BlackRock funds, and you see the power. BlackRock votes on behalf of investors who don't even know BlackRock is voting for them. Investors like you. Now, let me show you why BlackRock is more dangerous than any monopoly in history. Standard Oil, 1870 to 1911. John D. Rockefeller built Standard Oil into the first great American monopoly. At its peak in 1904, Standard Oil controlled 91% of oil refining, 85% of final sales in the United States. Rockefeller owned the refineries, the pipelines, the distribution networks, the retail stations, everything. In 1911, the Supreme Court ruled Standard Oil was an illegal monopoly. They broke it into 34 companies. But here's the key difference you need to understand. Standard Oil controlled one industry, oil. BlackRock controls ownership across all industries. Standard Oil could set the price of kerosene. BlackRock influences corporate policy at every major company in America. Standard Oil's monopoly was visible. Eventually destroyed, BlackRock's monopoly is invisible because it's structured as diversified investment. And here's the genius. There's no law against one company owning 7% of every company. It's a monopoly that's legal because it's called asset management. J.P. Morgan's Trust, 1890s to 1912. J.P. Morgan didn't just run a bank. He controlled a vast web of corporations through interlocking directorates. Morgan Partners sat on the boards of U.S. Steel, General Electric, AT&T, hundreds of other companies. In 1912, investigators found that Morgan and two other banks controlled corporations worth $22 billion. That was the entire U.S. money supply at the time. But Morgan's control was personal and direct. He sat on boards. He appointed executives. He dictated strategy. His power was obvious, which made it politically vulnerable. The 1913 Clayton Antitrust Act banned interlocking directorates. Morgan's empire crumbled. BlackRock learned from this. BlackRock doesn't put Larry Fink on corporate boards. They don't need to. They own the stock. They vote the proxies. The power is indirect ... but more absolute. You can ban interlocking directorates. You can't ban asset managers from voting client shares. That's their job. The control is the same, but the legal structure is bulletproof. Now let me break down the 5 mechanisms through which BlackRock controls markets, and controls you. These aren't conspiracy theories. These are business model features, documented, public, and incredibly powerful. Mechanism 1, concentrated ownership across all industries. BlackRock is the largest or second largest shareholder in 495 of the S&P 500 companies. Let me give you specific numbers. Technology. Apple. BlackRock owns 6.8%, worth about $200 billion. Microsoft. BlackRock owns 7.1%, worth about $210 billion. Amazon. BlackRock owns 6.2%. TESLA 5.6%. Google 6.4%. Meta 7.5%. Nvidia 6.9%. Banking. JP Morgan Chase. BlackRock owns 6.8%. Bank of America 7.3%. Wells Fargo 6.9%. Energy. ExxonMobil. BlackRock owns 7.2%. Chevron 7.1%. Pharmaceuticals. Pfizer. BlackRock owns 8.1%. Johnson & Johnson 7.4%. Consumer goods. Procter & Gamble 6.7%. Coca-Cola. 7.3%. Walmart 6.5%. Do you see the pattern? BlackRock owns 6 to 8% of every major company in America. Not a single company. Every major company. This creates a monopoly of ownership. BlackRock doesn't control 91% of one industry like Standard Oil. It controls 7% of every industry. And that's more power. Because when you own stakes in all competitors, you don't care which company wins. You win regardless. Here's what this means for you. Imagine BlackRock owns 7% of Apple and 7% of Microsoft. Apple and Microsoft compete in computers, phones, Cloud services. If Apple gains market share, BlackRock's Apple stake gains value. If Microsoft gains market share, BlackRock's Microsoft stake gains value. BlackRock doesn't care who wins. They own both. This removes competitive pressure. Now extend this logic across your entire life. BlackRock owns stakes in Delta, United, American Airlines. They don't care which airline wins. So, do you think BlackRock pressures airlines to compete on price and service? Or do they prefer all airlines keep prices high and maximize profits across the sector? The incentive is obvious. Suppress competition. Maximize industry profits. This is called common ownership theory, and economists have documented exactly what it costs you. A 2017 study found that airline ticket prices are 3 to 7% higher because of common ownership by BlackRock, Vanguard, and State Street. Airlines don't compete as aggressively because their largest shareholders own all competitors. That's money out of your pocket every flight you book. The same pattern exists in banking. Banks with common ownership pay you lower interest rates on your deposits and charge you higher interest on your loans. Why compete for your business when their shareholders own all the competing banks? The result: billions transfer from you to shareholders. In pharmaceuticals, common ownership correlates with higher drug prices, those prescriptions you're paying for. More expensive because of BlackRock's ownership structure. In every sector, common ownership suppresses competition and raises the prices you pay. This is the first mechanism of control. Not owning one company outright. Owning significant stakes in all companies and shaping industry-wide behavior. Against you, mechanism 2. Proxy voting power and corporate governance control. When you own stock through a mutual fund or ETF, you technically own the stock, but you don't vote it. The fund manager votes on your behalf at BlackRock's scale. This is unprecedented. BlackRock votes proxies for $10 trillion in assets. In 2023, BlackRock cast votes at over 16,000 shareholder meetings globally. They voted on executive compensation, board elections, mergers, corporate strategy. Environmental policies, social policies. BlackRock voted your shares. And unless you specifically instructed BlackRock otherwise, which almost no one does, BlackRock voted however Larry Fink and his team decided. Here's how this works. Every public company has an annual shareholder meeting. Shareholders vote on board members, executive pay, major decisions. Voting power is proportional to shares owned. If BlackRock owns 7% of Apple, it controls 7% of votes. That doesn't sound like much. But in a company with dispersed ownership, 7% is often the largest single voting bloc. Here's why. Most individual shareholders don't vote. They don't even know when meetings are. Retail voting participation is less than 30%. So institutional investors control outcomes. And BlackRock is the largest. Let me give you a concrete example. In 22-1... ExxonMobil faced a proxy fight. A tiny activist hedge fund called Engine Number One, owning only 0.02% of Exxon, nominated 3 directors to push the company toward renewable energy. Exxon's management opposed this. They spent millions fighting it. The vote came down to large institutional shareholders. BlackRock voted with the activists. So did Vanguard and State Street. The activists won. 3 new directors were elected against management's wishes. Exxon is a $400 billion company. Its management was defeated by a hedge fund owning 0.02%. Because BlackRock's 7% stake was decisive. This is corporate governance control. BlackRock doesn't manage Exxon day to day, but they decide who sits on the board. And the board decides strategy, CEO, compensation, briefing. Now, BlackRock says it votes in the best interest of its clients. But who are its clients? Millions of retail investors who have no idea BlackRock is voting for them. Pension funds that gave BlackRock discretion. Each client might have different interests. How does BlackRock reconcile them? They don't. BlackRock votes according to BlackRock's guidelines, set by Larry Fink and his team. And Larry Fink has very specific views. Every year, Fink writes a letter to CEOs of companies where BlackRock is a major shareholder. These letters aren't suggestions. They're directives backed by $10 trillion in voting power. In 2020... Fink's letter focused on climate change. He told companies to disclose climate risks and align with the Paris Agreement. Companies that didn't comply faced BlackRock voting against management. In 22-1... Fink's letter focused on racial equity and stakeholder capitalism. In 2022 and 2023, net zero commitments and diversity targets. These are Larry Fink's personal policy preferences. But because BlackRock votes $10 trillion, Fink's preferences become corporate policy across America. Without election, without democratic accountability, one man's views, amplified by $10 trillion in voting power, shape policy at 500 of the largest companies in America. Larry Fink has more voting power over corporate America than any individual in history. More than Rockefeller. More than Morgan. Because Fink votes on behalf of millions of people who don't even know he is voting for them. People like you. Mechanism 3. The Aladdin system. This is BlackRock's secret weapon. And most people have never heard of it. Aladdin is a software platform that manages risk for investment portfolios. It tracks every asset, every liability, every derivative, and calculates risk in real time. BlackRock built Aladdin in 1988, over 35 years. It's become the operating system for global finance. Here's the scale. Aladdin manages $21 trillion in assets. That's not just BlackRock's $10 trillion. Aladdin is licensed to other institutions. Over 200 clients use it. Pension funds like CalPERS, insurance companies like AIG, sovereign wealth funds, even other asset managers. BlackRock software sees and analyzes risk across $21 trillion. That's roughly 10% of the world's total financial assets. Why does this matter to you? Because Aladdin doesn't just track risk. It recommends actions. If Aladdin identifies a risky asset, it suggests selling. If it identifies an opportunity, it suggests buying. And because Aladdin manages 21 trillion across hundreds of institutions, its recommendations move markets. If Aladdin tells 50 pension funds to sell a particular bond, they sell simultaneously. That bond's price crashes. This is algorithmic market control. And here's the scariest part. Aladdin is a black box. BlackRock doesn't disclose its algorithms. They're proprietary. But those algorithms are shaping investment decisions across the global financial system. One system, controlled by one company, directing $21 trillion in capital. If Aladdin has a bug, if its risk models are wrong, if it recommends the same action to hundreds of clients simultaneously, it could trigger a market crash. In 2008, the financial crisis was caused partly by flawed risk models. Banks used similar models that underestimated housing risk. When housing crashed, all the models failed simultaneously. Now imagine that scenario, but instead of multiple flawed models, it's one model, Aladdin, controlling 21 trillion. If Aladdin miscalculates risk, the entire financial system is at risk, including your savings, your retirement, your 401k, and there's a deeper issue. Aladdin gives BlackRock visibility into the entire financial system. BlackRock sees what other institutions are buying and selling. They see risk exposures across the market. This is insider information on a systemic scale. BlackRock claims they use Chinese walls to separate Aladdin data from investment decisions. But the wall is internal. There's no external verification. We're supposed to trust that BlackRock doesn't use this God's eye view to front-run markets. Maybe they don't, but the temptation and the capability both exist. Mechanism 4. Government contracts and the revolving door. BlackRock isn't just powerful in markets. It's powerful in your government, and the relationship is symbiotic. BlackRock alumni staff the Treasury, the Fed, the White House. Government officials retire to BlackRock. This revolving door ensures that government policy aligns with BlackRock's interests. Let me give you specific examples. In March 2020, when COVID crashed markets, the Federal Reserve needed to intervene. But the Fed isn't allowed to buy corporate bonds or ETFs directly. So the Fed hired BlackRock. BlackRock was contracted to buy corporate bonds and ETFs on behalf of the Fed. BlackRock charged fees for this service and bought assets, including BlackRock's own ETFs. Let me be clear about the conflict. BlackRock was hired by the Fed to buy corporate bond ETFs. BlackRock managed the largest corporate bond ETF platform. So BlackRock bought its own ETFs with Fed money, driving up the value of those ETFs, benefiting BlackRock and its clients. BlackRock was player and referee. They decided which assets the Fed should buy and profited from those purchases. This is regulatory capture. Now look at the revolving door. Brian Dees was BlackRock's global head of sustainable investing. In 2020, you left BlackRock to become director of the National Economic Council under President Biden. That's the president's top economic advisor. Dees helped design the Biden administration's economic policy, including climate and energy policy, areas where BlackRock has massive investments. Michael Pyle was BlackRock's global chief investment strategist. In 2021, he became chief economic advisor to Vice President Kamala Harris. Wally Ademo was BlackRock's chief of staff. He is now Deputy Treasury Secretary, the number 2 official at Treasury. These aren't low-level staffers. These are top economic policymakers who came directly from BlackRock. The reverse flow exists too. Stanley Fischer, former vice chair of the Federal Reserve, joined BlackRock as senior advisor. Philip Hildebrand, former head of the Swiss National Bank, is BlackRock's vice chairman. This creates a closed loop. BlackRock alumni make policy. That policy benefits BlackRock. BlackRock hires more government officials. The loop continues. When the government intervenes in markets, BlackRock profits. COVID bailouts, BlackRock was hired to execute them. Climate policy. BlackRock position as the leader in green investing. Financial regulation. BlackRock helps write it. Ensuring rules benefit large asset managers and hurt smaller competitors. This isn't illegal. This is how power works in the 21st century, not through crude corruption, through sophisticated alignment of interests. Mechanism 5. Information asymmetry and data dominance. BlackRock has more data about companies, markets, and economic trends than any other institution, except maybe the NSA. This data comes from 3 sources. First, Aladdin, analyzing 21 trillion in assets. BlackRock sees investment flows, risk exposures, trading patterns across the global system. Second, BlackRock's 10 trillion in direct assets. They invest in virtually every major company. They have researchers, analysts, access to corporate management everywhere. Third, BlackRock's political connections give them early insight into policy changes. This information asymmetry is power. BlackRock knows what other institutions are buying before they buy it. BlackRock knows which sectors are at risk before markets know. BlackRock knows policy changes before they're announced. An information advantage is profit. If Aladdin data shows that 30 pension funds plan to sell emerging market bonds next quarter, BlackRock knows emerging market bond prices will fall. BlackRock can position accordingly. It's not illegal because it's not company-specific inside information. It's systemic flow data. But the effect is the same. BlackRock profits from information other market participants don't have. Information you don't have. These 5 mechanisms: concentrated ownership, proxy voting power, the Aladdin system, government contracts, and the revolving door, and information asymmetry. They combine to create unprecedented market control. No historical monopoly has had all 5 simultaneously. Standard Oil controlled production. J.P. Morgan controlled capital. But BlackRock controls ownership, governance. Risk management, policy, and information. Across the entire economy. This is the ultimate monopoly, and it's growing. Now, let me show you the circular ownership problem. This is where it gets truly dystopian. BlackRock is a publicly traded company. So, Who owns BlackRock? The largest shareholder in BlackRock, is Vanguard, about 8%. The second largest is BlackRock itself through employee stock plans. The third largest is State Street. But here's the twist. Vanguard owns 8% of BlackRock. BlackRock owns 7% of Apple. Vanguard owns 8% of Apple. So Vanguard and BlackRock are each other's largest shareholders and co-investors in every major company. This creates a circular ownership structure. The same small group of asset managers owns each other and everything else. BlackRock, Vanguard, State Street. They collectively own about 20% of every S&P 500 company on average, and they own each other. This is 21st century monopoly. In the 20th century, monopoly was one company dominating one market. Standard Oil owning 91% of refining. In the 21st century, monopoly is 3 companies owning 20% of everything and owning each other. The effect is the same. Competition is suppressed. Prices rise. But the structure is legal because no single firm has majority control of anything. They just have coordinated minority control of everything. Now, who profits from BlackRock's monopoly? And more importantly, who loses? First, Larry Fink profits. His net worth is over $1 billion. Annual compensation between $25 and $30 million. As BlackRock grows, Fink gets richer. Second, BlackRock shareholders profit. BlackRock stock is up over 500% since 2010. But here's the irony. BlackRock's largest shareholders are Vanguard, State Street, and other asset managers. The oligopoly profits from itself. Third, institutional investors and index fund holders profit, with caveats. If you own an S&P 500 index fund, you've benefited from market gains. But you've also contributed to market concentration without knowing it. Your investment empowered BlackRock to vote your shares. In ways that suppress competition and raise prices, you gained in your portfolio, but you lost as a consumer. The prices you pay for airline tickets, prescription drugs, banking services, all higher because of common ownership. You're profiting as an investor while losing as a consumer. And the net effect might be negative. Now, who loses? You do. Small investors lose because they think they own stocks. You don't. You own a claim to returns. BlackRock owns the stock and votes it. You have no say in corporate governance. You're economically invested but politically disenfranchised. This is neo-feudalism. You don't own property. You own a claim to income from property the Lord owns. BlackRock is the Lord. You lose as a consumer because common ownership raises prices. 3 to 7% higher across affected industries, according to academic studies. That's billions extracted from you and transferred to shareholders. You pay more for everything ... Because BlackRock's ownership structure incentivizes price coordination. Small businesses lose because they compete against giants that BlackRock backs. If you run a small business, you're competing against companies with $10 trillion behind them. You can't compete. Small businesses die. Entrepreneurship declines. Market concentration increases. Workers lose because common ownership suppresses wages. A 2018 study found that common ownership reduces wages by about 10% in affected industries. When the same shareholders own all employers, employers have less incentive to compete for workers. If you own Walmart and Target, you don't want them bidding up wages. You want them keeping labor costs low across the sector. Your wages suffer, shareholders profit, democracy loses. BlackRock has more influence over corporate America than Congress. Larry Fink's annual letter to CEOs is more consequential than most legislation. Corporate policy on climate ... biodiversity ... governance. All shaped by Fink's preferences backed by $10 trillion. This is not democratic. Fink isn't elected. BlackRock's proxy votes aren't public in real time. The most powerful force shaping corporate America is accountable to no one. Capitalism itself loses. Capitalism is supposed to be about competition, creative destruction, innovation. But when the same shareholders own all competitors, competition disappears, prices rise, innovation slows. This isn't capitalism. It's something else. Corporate socialism for the big, brutal competition for the small. A system where BlackRock, Vanguard, and State Street own everything. And everyone else fights for scraps. Do you really think this system was designed to benefit you? Now ... Let me show you why this is accelerating. The shift to passive investing is unstoppable. In 2000, active mutual funds managed 95% of assets. Index funds were niche products. By 2024, index funds manage over 50% of U.S. mutual fund assets. Every year, billions flow out of active funds and into passive index funds. Why? Because index funds charge lower fees. 0.03% for an S&P 500 ETF versus 1% for an active fund. And most active funds underperform the index anyway. So you rationally choose index funds. But this rational individual choice creates irrational systemic outcomes. The more money that flows into index funds, the larger BlackRock becomes. The larger they become, the more voting power they have. The more voting power they have, the more they can suppress competition and raise prices. This creates a feedback loop. Index funds suppress competition. Suppress competition means companies earn higher profits. Higher profits mean stock prices rise. Rising stock prices attract more money to index funds. The loop accelerates. By 2030, analysts predict index funds could manage 70% of U.S. equity assets. At that point, BlackRock, Vanguard, And State Street would control voting majorities in most large companies. The oligopoly becomes absolute, and there's no obvious stopping point. Why would anyone choose an expensive active fund that underperforms when you can buy a cheap index fund? The logic is irresistible at the individual level, but at the systemic level, you're building a monopoly structure that destroys the capitalism index investing claims to represent. Here's what's coming. As index funds grow, active management becomes niche. Only the largest active funds survive. Smaller ones disappear. This further concentrates power. Then ... As BlackRock's voting power approaches majorities ... expect regulation. But the regulation will be written with BlackRock's input. It'll create compliance requirements that BlackRock can handle ... But smaller competitors can't. Regulation will cement BlackRock's position. Finally ... Expect BlackRock to expand into new areas. They're already moving into private markets ... infrastructure ... real assets. Eventually, BlackRock could own not just public stocks, but private equity ... highways ... bridges ... water systems. This is the trajectory from asset manager to asset owner, from voting shares to controlling assets. So what can you do? How do you respond to a system where BlackRock owns everything? You have three options. Option 1 ... accepted and benefit. Own index funds. BlackRock's dominance makes index funds profitable. If you can't beat them, join them. Buy IVV. Ride BlackRock's monopoly to returns. This is morally neutral. You're not creating the system. You're just navigating it. But understand, your investment empowers BlackRock's voting power and contributes to market concentration. Option 2 ... divest and invest actively. Refuse to own index funds. Pick individual stocks. Invest in actively managed funds that don't engage in common ownership. This is harder. It requires research. You'll pay higher fees. You might underperform. But you're not contributing to BlackRock's monopoly. This is the principled approach ... but it's costly. Option 3 ... political action. Demand antitrust enforcement against common ownership. Support politicians who understand this issue. Push for regulations requiring asset managers to pass voting rights to individual investors. This is difficult because most people don't understand the problem. But if enough awareness builds, reform becomes possible. Historical monopolies were broken up through political action. Standard Oil, AT&T, Microsoft, BlackRock could be next. But only if people understand what BlackRock actually is. Let me leave you with this. BlackRock is not evil. Larry Fink is not a villain. BlackRock's employees are not conspiring to control the world. They're operating within a system that's legal and even encouraged. The problem is the system itself. A system where index investing, promoted as democratic and efficient ... creates oligopoly. A system where passive management concentrates active power. A system where owning 7% of everything is legal, but owning 91% of one thing is illegal. The law hasn't caught up to the structure, and the structure is accelerating. In 1988, BlackRock didn't exist. In 2024, it manages $10 trillion. By 2034, it could manage $20 trillion. At that scale, BlackRock won't just be the largest asset manager. It'll be the largest economic force in human history. Larger than any government, more powerful than any empire. Because empires control land and people, BlackRock controls ownership. And in capitalism, ownership is everything. The question isn't whether BlackRock is powerful. It obviously is. The question is whether that power is compatible with capitalism, ... democracy, and your freedom. When one company is the largest shareholder in Apple, ... Microsoft, ... Amazon, ExxonMobil, ... JP Morgan, ... Pfizer, and 494 other S&P 500 companies. When one AI system manages $21 trillion in assets ... When one CEO's annual letter shapes corporate policy across America ... When one institution is player referee and scorekeeper in global markets. That's not capitalism. That's oligarchy. And the oligarch is BlackRock. If this documentary showed you a system you didn't know existed, if you understand now that your stock ownership is a fiction and BlackRock owns the reality, then you have a choice to make. Accept it, divest from it, or fight it. Each path has costs. But doing nothing guarantees that BlackRock's 10 trillion becomes 20 trillion. Its 7% becomes 10%. Its oligopoly becomes absolute. BlackRock, the company that owns everything, the monopoly that's legal, the power that's invisible, until you see it. And once you see it, you can't unsee it. Welcome to the world BlackRock built. Population everyone, including you. I'm Walter Grant, and this has been Draxiver.